It's an exciting day today. We got Jay Powell. He's talking right now, laying it down. Nothing really new. But before we kind of get into that, into some of the kind of really breaking news that's going to be moving, really macro economies, the economy, global economy.
Yep.
Not just in the United States, but the Federal Reserve. They can be the limiter or accelerator on the economy, and we've had a lot of these macro discussions of what are rising interest rates? How does that affect the market, specifically real estate? And how does this slowing growth? Are we going to enter a recession, a technical recession? Mm-hmm. It's bred a lot of uncertainty and just a lot of dark clouds. But I think there's some green shoots and some positivity that we can look at as well. And what a lot of this means, because there's a ton of nuance to it.
Yeah.
And you can just be confused and uncertain. But I think there's some opportunities that we should be paying attention to. But first, before we get into that, how's your week going, Matt?
It's going pretty well. My kids' baseball game, they won. So
hey, there we go. Congrats. Is this like coach pitch, or is this like the T-ball, or what is it?
It is one above T-ball. They have a little catapult.
Oh, okay.
That throws the ball.
Very cool.
Yeah. So I think it replaced the dad's pitch.
Yeah, but the dads probably weren't very good, I don't know.
The same team pitches to each other, so there's no cheat.
Yeah. That's cool. All right. Yeah. Well, that's awesome. Well, let's just get right into talking about what's going on over at the Federal Reserve. Because again, this is live when we're recording this. We're recording this May 4th, about 2:50 in the afternoon. So you're probably going to be watching this on Thursday or Friday, assuming that you are subscribed to the Gray Capital YouTube channel, or you are getting the podcast. If you're listening to the podcast, watching, just looking at Jerome Powell, answering some questions from reporters about the most recent decision to raise the interest rate of the Fed funds rate 50 basis points.
Mm-hmm. He got right to the point too. In his opening remarks, he didn't bury the lead. It was almost a foregone conclusion, was how quick he got to it.
Yeah, exactly. Well, and everyone knew. Yeah. I mean, it had been communicated loud and clear. Mm-hmm. They had been out front and center saying that most likely we're going to see a 50 basis point increase to the Fed funds rate, and as well as discussing shrinking the balance sheet.
Yeah.
All with the idea of bringing inflation in check, taming inflation, trying to slow growth down so we don't overheat, so inflation doesn't impact more people.
So raising the interest rates 500 basis points, I can wrap my mind around that.
50, yep.
But then what about this reducing the balance sheet? And does that have any? So obviously, it's like I know that has an effect on interest rates, maybe an indirect effect. But does it have any other effects in addition to interest rates? Does it make it harder for people to get a loan in the future?
I think it's a good question, and I mean theoretically, it should, because what you're doing is removing liquidity from the system. I mean, the Federal Reserve has been buying billions of treasuries and mortgage-backed securities, agency mortgage-backed securities, really throughout the pandemic. I mean, I think there was 60 billion of mortgage-backed securities a month, and I think another 50 or 60 of treasuries. So now they've announced, and again, they just mentioned this, looking at reducing the balance sheet now by about $30 billion worth of treasuries every single month, and then about $17.5 billion of mortgage-backed securities. Now, the actual treasuries are going to increase to $60 billion after a few months, and then they're going to increase the sale of mortgage-backed securities by up to $35 billion over the next couple months. In addition, wow. This is just another tool that they can use, because they've got a couple tools. One's just moving rates. One is buying assets, buying bonds. And those mortgage-backed securities, those are loans for real estate.
Yeah.
Mortgages. And so not only they're going the other way, it's not like they're going to just stop buying, but they're actually going to be selling off. So there's going to be less liquidity. Mm-hmm. They've been the largest buyer of these mortgage-backed securities. And so that for the lenders who are actually making these loans, if you always know you've got a buyer, it's easy to make the loans. But if you're not sure if you've got a buyer, and in fact, you've got the biggest buyer who's selling right now, that can decrease the amount of liquidity and make just less money available for loans. You can't get a loan. You can't do a business venture. That has a result of slowing the economy.
Yeah. Okay. So banks then faced with that problem that they don't have the money to give the loans out.
Potentially. There's other buyers out there in the market, besides the Fed, but they've been the largest buyer for the last about 2 years or so.
So then, as a solution, supply and demand, then they either raise the rates.
Well, it's driven by market forces. So when you have somebody selling something, the price of the value of like a bond is inverse to the interest rate. So when you're selling something, that price is going to go down and down and down. And that means the interest rate is going to go up and up and up.
Yeah.
Because if they need to incentivize someone you want to have get a higher interest rate if the value of something is relatively lower.
Okay.
So theoretically, the interest rates on mortgage-backed security on mortgages will continue to go up. Now, most of those mortgages are based off of the 10-year Treasury or indexed to the 10-year Treasury, which, as we're seeing at least right now, was hovering right around 3%, which is a full 100 basis points more than it was just a couple months ago.
Yeah.
And so I think it's important just to make sure that everyone knows about what we're talking about in terms of interest rates being moved, because I know for a lot of people, they think the Fed controls all the interest rates, and they really only control.
Just turn the dial up.
Yeah, they're like, let's just turn it all up. But the only interest rate they really control is that the Fed funds rate, and that's like one of the shortest term financing rates, and they have less control, really, not as much influence over like the longer dated maturities, like the 10-year Treasury. That's more market driven.
Okay.
And that's why we've seen, the 10-year has already, a lot of the movement has already been priced in. And so that's why we went from 2% a couple months ago all the way up to 3%, where we were at, 0.49% in the 10-year Treasury back in 2020.
Yeah.
So that's different from that Fed funds rate that basically kind of sits there until the Fed moves. But then that gives room for all the other rates to move up as well.
Okay. And then just to kind of circle back to the asset purchases, then if they want an effect on the other rates on the 10-year maybe, is that what these asset purchases are meant to kind of indirectly move, or is that?
I think it's in general. I think that there was a lot of talk, especially in 2021 or 2020 and 2021, about like yield curve control, where they're really trying to affect like the longer end of the curve by buying more 10-year Treasuries or selling 10-year Treasuries or whichever dated maturity they're trying to influence, because they can be such an influential buyer.
That makes sense.
But I think that's not as much the stated goal as we're just trying to slow down the economy in order to slow down inflation.
Okay.
Now there's some takeaways. I made some notes while Jay Powell was speaking, and just I want to kind of go through some of them. So we mentioned the reduction in the size of the Fed's balance sheet, but also looking out in the future for future rate hikes. They are going to be contemplating additional 50 basis point increases to the Fed funds rate at the next several meetings. Steve Leisman asked if they were considering, from CNBC, asked if they were considering rate increases beyond 50 basis points, maybe 75 or a full percentage point. Jerome Powell said that rate increases at 75 basis points or more are not currently being considered. The only thing being considered are 50 basis point increases, but all those decisions will be made essentially in real time at the meetings themselves, although they did quite a bit of signaling prior to this meeting. So they really wanted to get the market prepared, not having to be such a they don't want it to just snap one day, rates are going to increase, even though that's the case. They want the market to be able to price as much as that in, so it's sort of a soft landing. So 50 basis points potentially at future meetings. They really want to get inflation down to 2%, of which is their target. But he said that there could be further surprises with inflation. They're going to be nimble. But he has highly attentive to the inflation risks in the economy.
Seems like he really led with that
Yeah.
Whereas before, maybe he wouldn't have mentioned, but they've got a
Yeah.
target. It's 2%.
Yeah.
And it's not this, last year we heard this talk about, no, it's really like it's like a
average.
moving target. Yeah. But they seem,
They hit their average now.
Yeah,
Because
yeah,
that was giving them room. They're like, now we're averaging a little bit over.
Yeah.
And does that mean they need to go negative now to get the average? But what we've talked about a lot is it all depends on what period you're using. Because if you go back 10 or 12 years, well, we were kind of below 2% for that quite a long time. But maybe that's in the past and doesn't mean as much anymore. I think here's is a really good point, and this is kind of sort of transitioning back to multifamily. The whole reason that they are doing this, can do this, is that the economy, and this is a paraphrase, but a near quote. The economy is strong enough to handle this tighter monetary policy.
Yeah.
The only reason why we can do this right now is because the economy is so strong and is on such solid footing.
that's a good point. Yeah.
The labor market is tight. Wages, I mean, we're seeing the highest levels of wage growth that we have really ever seen, which is very positive. We still have very strong household and businesses are in very good standing. And so the idea here is that they're trying to find that soft landing, or as Jay Powell said in the press conference, hey, maybe a softish landing, maybe not soft, like super soft, but like soft enough.
Yeah.
And what we've been talking about, Matt, is it's easy we could see a recession, but is it going to be a recession of the real economy, or is it going to be more of a real technical recession?
And in some more of the articles that we cover this week, there is really some great signs that we've got a lot more armor this time around than we did during the Great Recession.
Yeah.
And there's a lot of great things that are going on in the economy. I just think it's almost like we've got to balance the books.
Yeah.
What I noticed too specifically was, Jay Powell was in this awkward position of having to talk about job creation as almost like a problem, and he's like, I'm promising job creation is going to go down,
and
then
wage growth,
and wage growth coming down, and which is, if you're an employer, the tight labor market is a problem, but it's just hard seeing that in the same sentence. And he did get a specific question that asked, well, you're going to lower job creation, is that going to mean there's an economic downturn?
Yeah.
And he's like, well, and that's what led him to say, yeah, well, it's going to be a little bit of a rough landing.
Yeah, he's like, it's not going to be easy. It's not going to be easy.
Yeah.
He's like, this is not going to be easy. But can we get through it where, again, like on a technical basis, recession, 2 consecutive quarters of negative GDP growth? We've already had one.
Yeah,
we've already had one. But again, a lot of people, it's kind of a nuanced understanding of it. But if you look at why it's negative in terms of, we're looking at a base effect, that we had incredible growth. I mean, you don't necessarily want to continue the same levels of growth. You want a little bit of like normalcy, and you can't get to that level of normalcy without some kind of reversion. So that's going to require maybe a little bit of negative growth to kind of get right there in the middle and the sweet spot.
Yeah.
And so the question is, we could easily be in the recession that we're all worried about. Could already be here. I mean, the stock market is, tech stocks are some down 50%. The broader market, I think, is down like 30%. So we've already seen, in public equities, that all already occur. We're in a bear market for bonds. And we're seeing negative GDP growth. I'm not saying it's going to be exactly like the pandemic recession, because we had all the layoffs and there was even more disruption. But I'm wondering if we could see, no recession is completely pain-free or painless, and there's still a lot of people that get damaged and it's not good. But is this kind of, we had the snap recession at the beginning of the pandemic. Do we need just one more kind of quick recession, even if it's just a technical one, before we kind of flush out the volatility and the noise out of the system, so we can return to some level of normalcy, even if that's elevated growth and looks different than it was pre-pandemic? But do we need one more kind of reshuffling to get to the other side? And so the question for us is, how does that affect multifamily apartments, real estate, and for any investor, how they're going to allocate themselves in this type of environment, because it's uncertain.
Yeah, no, that I think that seems to be the big takeaway is if you have to wait on every eyebrow raise of Jay Powell, during these meetings and try to predict things, that's an uncertain environment anyways. You don't want to be in that situation, and hopefully they want to create a predictable environment, and that's what's a little bit better for investment. But I will say, the amount of savings that individuals have and that the economy has is at an all-time high.
Yeah.
And so that could be a really, you could lop that off. That's giving people cushion. Maybe that's why we aren't seeing so much more of a reaction, so much more like anxiety and alarm bells. People are kind of calling for it, but it's not hitting the headlines. People are talking about inflation. They're not talking about, stagnation. Maybe that's because there's just more of an economic cushion with that savings.
Yeah. Maybe a little bit there's more stagflation talk, I guess, these days, but the economy seems to be really continuing to cook as things open up. But they're all kind of external factors that we have to be looking for that you either could continue to drive inflation or not. I mean, China locking down. I mean that's one factor. Obviously, the war in Ukraine is another major factor that we still don't know. But to me, it's just that there's so much clouded uncertainty. People just aren't sure what to do, if to do anything at all. And I think having a decent cash position isn't a bad idea right now. But we also have to look at some of those asset classes that are relatively insulated, that are opposed to outperform. And again, I'm really not just saying this as a major investor into multifamily and apartments. I've kind of done a reassessment of all right, what are the conditions right now? What's the new thesis? Because we're in a different world than we were, 6 months ago, 6 months before that. It keeps changing. The short-term conditions are changing. Not a lot on the long term has changed. And in fact, some of the long-term changes or the big macro changes are even more beneficial to multifamily. And I see continued performance.
Yeah.
Now, how interest rates are going to affect transactions, that's a slightly different story. That's more of a near term. But looking at a long-term hold, you still see some really positive fundamentals.